Properties at 68% occupancy, we're just losing every month.
You can't just build a nice building and expect people to show up. In today's market, you do need professional marketing.
So what made the difference? Professional marketing, smart pricing, and excellent execution from day one.
Live from Reno, Nevada, this is the Next Level Property Management Multifamily Podcast, offering an inside look at the deals, trends, and strategies shaping the Northern Nevada multifamily market. Brought to you by Next Level Property Management, delivering over 25 years of high-performance multifamily management and consulting experience. Through data-driven insights and local market expertise, we're redefining what it means to take multifamily strategies to the next level. And now here are your hosts, T. Tran and Chris Fody.
Hey guys, welcome back to another Next Level podcast. T and Fody here with you. And today we're going to dive into the 2025 Reno Multifamily Market Review. And honestly, this year's data is going to tell us a very interesting story.
Yes, it really does. And what I think is going to be the most valuable thing about this conversation is that we're not just going to read you the numbers from the ALN reports. We're going to show you what those numbers actually mean, where they line up with what we've been seeing on the ground, and then honestly, where we're seeing that they don't really line up much at all.
Yeah, exactly. Because the weird thing is we manage communities all across multiple submarkets in Reno, and we talk to other operators every single day. And what we see actually happening with concessions, marketing costs, occupancy, there's some gaps between the reported data that we're seeing and our on-the-ground info.
Yeah, so if you're an investor looking at deals or a developer trying to decide whether to break ground on a project or even an operator trying to figure out your 2026 budget, I think this is going to be essential information. So we're going to walk through each major submarket, talk about what actually happened in 2025, and then we give you our outlook for what's coming in 2026.
Yeah, so let's start with the big picture numbers, right? We're going to break down each submarket, and then we're going to wrap up with specific action items depending on whether you're investing, developing, or you're just operating in this market.
So let's talk about what happened in 2025 from a market-wide perspective. Occupancy climbed from 88.3% at the end of 2024 to 91.4% at the end of 2025. That's a 3.1 percentage point gain, which is actually pretty substantial. The market absorbed 2,931 units during the year while only adding 965 net new units. So you're looking at absorption that went well beyond just filling the new supply. The market was backfilling the vacancy from all those lease-ups that struggled in 2024. And this is exactly what we predicted in last year's review, right? We said 2025 would be a stabilization year, not a boom year like pre-pandemic years, but steady recovery and absorption. That's exactly what played out.
Yeah, for sure. So effective rents, and this is, remember, asking minus concessions, ended the year at $1,713. That's about a 5.5% year-over-year growth. So on the surface, that looks pretty healthy, but here's what we need to pause and actually talk about, right? The effective rent number is based on reported concession data that we believe is significantly understated. And I mean significantly, like off by a factor of 2 to 4 times. The ALN data and other market reports are showing that 23% of properties are offering concessions with an average package around 6.2% of annual rent. But our on-the-ground research tells us something completely different.
We literally called 10 different communities across the market, but what we found was that basically every property is offering something. From 1 month free, 2 months free, 3 months free. Obviously, there's some look and lease bonuses out there. And the concession load that we found is way higher than what's being reported. And that does matter tremendously because if effective rent is calculated by reducing asking rent by the concession percentage, and if that concession percentage is wrong, then the whole effective rent number is wrong as well, which means anyone underwriting deals based on that data is working with flawed assumptions. We're going to break this down in detail and show you the math, but first, let me talk about what the quarterly progression looked like because that tells you a lot about how the year unfolded.
Yeah, and it was not a straight line up.
Not at all. Quarter one started at 88.7% occupancy, which was barely above where 2024 ended. Then quarter two actually dropped to 87.7% as new supply hit faster than the absorption. But quarter three was the turning point. Occupancy surged to 90.7% with 1,975 units absorbed in just a single quarter. That's when we really saw momentum shift. Properties that have been struggling to fill, suddenly they had traffic. Lease-ups that looked like they might struggle for years started to gain some traction. The market found its footing. Then quarter four came in at 91.4% with actually negative absorption of 108 units. But that's not concerning. That's just the market reaching a healthy occupancy level. You're not going to keep absorbing hundreds of units per quarter when you've already gone above 91%.
Right. And I think that one of the things that's important to understand is what occupancy level actually means for operators. So at 91.4% market-wide, that still leaves about 5,400 vacant units out of roughly 63,000 total. So while it feels much healthier than 88%, there's still plenty of vacancy to work through. And that 91.4% is an average. Some submarkets are way above that and some are below. North Valley, for example, ended the year at 76.3% occupancy. So it's a serious problem for any property in that submarket. We're definitely going to dive into each submarket, but before we do that, I wanted to address the concession data issue head on because honestly, this is probably the most important thing that we're going to talk about today. So we just talked about how ALN is reporting 23% of properties are offering concessions with an average package of about 6.2% of annual rent. But our team doing market research across the region, different submarkets, different products. I mean, we're talking new, older, downtown, suburban, different price points. All of those properties confirmed that they're actually offering 1 to 2 months free rent, that look and lease that Fody mentioned earlier, and that ranges from $500 to $1,000. So for us, that's 100% concession activity in our sample versus the 23% market-wide that's being reported. I'm not saying 100% of all properties in the market are offering concessions, but it's got to be higher. It's got to be way higher than 23%. And I think it's actually closer to 60 to 70%. And I feel like I'm being conservative there.
Yeah, I agree. And I'm going to jump in here with just some basic math because I think this will make it clear why these numbers don't really make sense. 1 month free on a 12-month lease equals 8.3% concessions, right? Because you're giving away 1 month out of the 12. 2 months free is 16.7%. 3 months free is 25%. So if the average concession package is 6.2%, that doesn't even cover 1 month free. But we know for a fact that 1 to 2 months free is basically standard across the market right now. And here's the thing, those look and lease bonuses don't always get captured in the concession data either. So you've got a property offering 2 months free, that's 16.7%, plus a $750 look and lease bonus on a lease at $2,000 a month. That bonus represents another 3.1% concession. So your total effective concession is actually close to 20%.
So what does that mean for the effective rent, right? If the real concession load is closer to 15% market-wide instead of 6.2, then again, quick math. If we're asking rent is reported at $1,743 and we apply that 15% concession, which I think is, again, conservative based on what we have seen, that's $262 per month. So actual effective rent would be around $1,481, not $1,713.
Yeah, and that's a $232 per month difference. So for a 200 unit property, that's $46,000 per month in revenue or over $550,000 annually. That's a fundamental difference in the property's performance. If you're an investor underwriting a deal and you're using that $1,713 effective rent number, you might think you're getting a property that's performing at a certain level. But if the real effective rent is $1,481, your whole investment thesis just changed. For lenders, this is also critical. A property might look like it's performing well on paper, but if it's relying on 2 to 3 months free to fill units, that's a sign of structural weakness. When market conditions shift or when the lease-up stabilizes, that property is going to struggle.
And here's the thing. We're not trying to bash the data providers here. It's not just ALN. We're seeing this across multiple market reports. And these organizations are providing valuable data on a lot of different metrics. But the concession reporting is clearly just not capturing reality. And it's something every market participant needs to be aware of. Our advice, and we're going to come back to this in the action items, is don't just rely solely on market reports for your effective rent data. Do your own research. Do the old school calling of the properties and shopping other properties. Talk to those leasing agents. Get real concession data. Underwrite conservatively with that 10 to 20% effective rent discount, depending on the submarket and your asset quality. Okay, so we're going to go ahead and shift gears right now, and we're going to talk about what's coming down the pipeline because the supply story is actually pretty encouraging for 2026.
So one of the best pieces of news in this entire review is that supply pressure is dropping dramatically. The market ended in 2025 with about 5,047 units in the development pipeline. That's down from roughly 12,000 units at the end of 2024. That means about 7,000 units delivered in 2025. So the market absorbed a lot of that, but it was painful. We saw occupancy drop in Q2 as that supply hit, and then we saw concession spike as properties competed for tenants. But here's the good news. Looking ahead to 2026, only 1,060 units are scheduled to start leasing. That's a 54% reduction compared to 2025. And if absorption continues at 2025 levels, around 2,900 units per year, the market would absorb all the new supply plus about 1,800 units of existing vacancies, which could push the market-wide occupancy above 93% by the end of 2026. That would finally give operators some pricing power to reduce or eliminate concessions.
Now, that's a big if, right? That assumes we have stable economic conditions, continued job growth, no major recession, even though we don't like the word recession. But the supply-demand balance is definitely shifting in favor of operators. The other thing to watch is the quarterly timing. Q1 2026 is going to see 350 units start leasing, and this is our heaviest quarter. So it'll drop to 175 units in Q2, about 335 in Q3, a little bit of a jump, and then 200 in Q4. So the second half of 2026 should be significantly easier, but there is a catch. This is really important. The remaining pipeline is heavily concentrated in 3 submarkets. North Valley has 1,800 units in the pipeline. It's about 36% of the total remaining supply. Downtown Reno has 1,500 units, about 30%. And West Reno has about 1,500 units, also close to 30%. So those 3 submarkets account for 96% of the entire pipeline.
Yeah, and that concentration really matters. So if you're an investor looking at deals or a developer trying to decide where to build, you need to understand which submarkets are facing continued supply pressure and which ones are starting to clear out. Central Reno only has 904 units in the pipeline. Sparks about 1,000. Carson City has 600. Those markets have much more manageable supply coming. And we're going to spend some time breaking down each submarket individually because the market-wide numbers mask some really important differences in submarket performances and risk. So before we do that, I think we should talk about what happened to our 2024 predictions because we made some pretty specific calls last year about what 2025 would look like.
Yeah, so last year we predicted 2025 would be the year of stabilization. Concessions persisting, also correct. They are still here. They are still widespread. They're here to stay for a second. And again, probably higher than what's being reported. We said operators would have to choose between aggressive marketing or aggressive concessions, and many of them are choosing both, which drove up the cost per lease significantly. We're hearing from some operators that they're spending $8,000 to $10,000 all in all to try and fill a single vacancy when you factor in the concessions plus marketing spend.
We also projected moderate rent growth, and this was also correct. We said rent growth would be in the mid-single digits, not the 10 to 15% we saw in the boom years. And sure enough, 5.5% effective rent growth is exactly that moderate, sustainable growth that we predicted. So we were pretty much on target with the big picture, but there was one surprise, and that was downtown Reno's recovery. We did expect downtown to improve, but we didn't anticipate a 21.4 percentage point occupancy gain year over year. That market went from 70.4% occupancy at the end of 2024 to 91.8% occupancy at the end of 2025. That's an incredible turnaround, and it speaks to the strength of demand for urban housing in Reno. But it also came at a cost. Almost every downtown property was offering 2 to 3 months free to fill up.
Right. Again, that occupancy came back, but the rent growth was achieved through heavy concessions. So it's not a clean victory. It's recovery with a significant revenue cost. And with another 1,500 units still in the downtown pipeline, we're going to be watching closely to see if that momentum continues or if supply once again is kind of overwhelming that demand.
All right, so let's dive into the submarkets because this is where it starts to get really interesting.
Yeah, let's start with downtown Reno because, again, this is probably the most dramatic story of 2025. When we look at the occupancy numbers, downtown went from that 70.4% at the end of 2024 to 91.8% end of 2025. Again, that's that 21 percentage point gain year over year. But those annual numbers don't tell you what actually happened quarter by quarter. So the market started Q1 at 84.1%, which seems, manageable. Q2 happens and occupancy actually drops down below 70%. I'm talking serious crisis here. Properties at 68% occupancy, we're just losing every month. Lenders are calling, owners are getting very concerned, and we're seeing concessions go crazy. 3 months free, 4 months free. We even heard of one property And I swear they were offering 6 months free, which is essentially cutting your annual revenue in half for those units.
And I remember that period in quarter two because we were watching this very closely. Properties were under some real pressure, but then something interesting happened in quarter three. Occupancy jumped up to 76.5%, and that was an 8.3 percentage point gain in a single quarter. So quarter four finished at 91.8%. So from that low point in quarter two to year end, downtown gained 23.6 percentage points of occupancy. Now the question is what that recovery actually costs. And we'll get to that in a second. But first, let's talk about what that tells us about demand. What this proves is that demand for downtown living in Reno is absolutely real. The urban lifestyle, walkability to restaurants and entertainment, proximity to the Riverwalk district, there's genuine demand for that product. The problem wasn't that people didn't want to live downtown. The problem was that supply completely overwhelmed the market's ability to absorb it in that short time period.
Now, effective rents ended the year at $1,411, which is up 5.7% year over year. It's actually the second highest rent growth among all the submarkets. But here's the reality on the ground. Those rents were achieved through massive concessions. And I will tell you, we saw this firsthand because one of our communities is right there in the Riverwalk district. It is a great location, great community, but had some operational challenges. Even that being said, we still ended the year at 95% occupied with zero concessions.
Yeah, that was great. And I want to pause on that because it illustrates something really important about what actually drives occupancy and retention. This community in the Riverwalk district isn't the newest property downtown. It's not a Class A, and you know there's a lot of those popping up there. But professional management execution kept occupancy at 95%, while brand new Class A properties nearby were offering 2 months free and still struggling to hit that 85% occupancy. The product quality at those properties was objectively better. They're newer buildings, they have better finishes and even more amenities, but the management execution wasn't there, and they couldn't fill units without heavy concessions. That tells you something about what really matters in this business.
And this is the lesson we keep trying to drive home. Property management quality often matters more than the actual physical asset. We also manage the Grand Canyon Muse, which is actually near Midtown. That property is 26 total units, and we finished their lease up in 2025. We got that community to 100% occupancy at zero concessions. So this is the same market where other properties are offering 3 months free. So what made the difference? Professional marketing from day one. There was a comprehensive digital marketing strategy. We understood exactly who would rent a $2,300 townhome in that location, and we reached them effectively. We priced intelligently. We didn't overshoot the market and then try to buy demand with concessions later. We priced at a premium, but within reach for that target demographic, and we delivered a product and experience that justified that pricing. So the combination of professional marketing, smart pricing, and excellent execution meant we did not need to give away that 2 or 3 months free just to compete.
Yeah, and this is critical for anybody that's developing or operating in downtown, or really any competitive submarket. You can't just build a nice building and expect people to show up. That strategy might have worked before when demand was overwhelming supply, but in today's market, you do need professional marketing. You need clear pricing strategy, and you need excellent execution. The properties that figured that out in downtown are stable and profitable. The ones that didn't are stuck in the concession trap and burning through cash every month trying to fill units. Now, here's the challenging thing going forward in downtown. There's still 1,500 units in the pipeline. That represents 30% of the entire metro's remaining supply, all concentrated in one submarket. For context, downtown delivered approximately 2,300 units during 2025 based on the pipeline reduction we tracked. The market proved it could absorb 2,300 units in a year, but at what cost? Nearly universal concessions across properties, aggressive marketing spend that drove up cost per lease significantly, and constant pressure on rents as properties competed for tenants. And now there's another 1,500 units coming over the next 18 to 24 months.
So our perspective on downtown for investors and developers is this. Demand has been proven, and that 21-point occupancy gain proves that people do want to live there. But supply risk is very real, and it's going to continue through 26 and probably into 27. So if you're looking to acquire property downtown, focus on stabilized assets that survive that shock. Those properties prove their market positioning. They already demonstrated they can maintain occupancy and rents even when the market was flooded with some new supply. So let's go ahead and move on to Central Reno and Airport because that's a totally different story.
Central Reno is the steady performer in the market. While downtown was experiencing those wild occupancy swings, Central just quietly delivered consistent, healthy performance. Occupancy ended 2025 at 92.9%, and that's up 3.5% points year over year. But here's what's impressive. Quarterly occupancy was rock solid and consistent around 92%. This market never dropped below 90% occupancy during the entire year. It's remarkable stability in a market that saw massive supply deliveries and competitive pressure. Effective rents finished at $1,754. That's up 3.3% year over year. Now, that rent growth is lower than downtown's 5.7%, or what we'll see in Sparks. But you know what? I'll take 3.3% rent growth with 92.9% occupancy over 5.7% rent growth achieved through heavy concessions any day, because the revenue stability is what matters for investors. Stable occupancy, steady rent growth, limited concessions, that's the recipe for predictable cash flow and strong NOI.
And Central Reno rents are significantly higher than downtown. You're looking at $1,754 versus $1,411. So that's that $343 per month premium. That's reflecting superior location, better demographics, and higher quality tenant base. Let's talk about that pipeline, right? Central Reno has about 900 units remaining, down from 2,400 units at the end of 2024. So the market absorbed roughly 1,500 units in 25 without breaking a sweat. And that's the lowest pipeline concentration of any of the major submarkets. 900 units left to deliver versus 1,800 in North Valleys, 1,500 in downtown Reno, 1,500 in West Reno. Central Reno is clearing out its supply pipeline faster than anybody else, which creates actually a really favorable supply-demand dynamic for 26. Less new supply hitting the market means existing properties can maintain their occupancy, reduce or eliminate concessions, and they can push rents a little bit more aggressively.
And the fundamentals are just superior to every other major submarket. Central Reno offers the best risk-adjusted returns in the market. Higher rents than downtown, more stability than North Valleys, better job access than Sparks or Carson City. The challenge is everyone knows this, so acquisition pricing is competitive. Cap rates are compressed, and you're going to pay a premium to get into this submarket. But you're paying that premium for a reason. All right, so let's talk about North Valleys, because this is a complete opposite story from Central Reno.
Yeah, North Valleys is kind of our problem child in the Reno market. I hate to say it that way, but this submarket has actually been pretty volatile for years, and 25 did nothing to help change that narrative. Occupancy ended the year at 76.3%, and that's by far the lowest of any of the major submarkets. Context, the market average is 91.4%, with Central at 92. North Valleys is sitting at 76. And the quarterly progression tells you everything you need to know about kind of what's wrong with this market. Q1 starts at 90%, which is healthy. It collapses to 76% in Q2. So this 14% point drop in one quarter, kind of harsh. Q3 recovers to 81%. But then Q4 drops again down to 76. So the market ended the year 5.2 percentage points lower than Q3. It's not the sign of a stabilizing market. And, here's what we think is happening. Supply is overwhelming that demand. North Valleys is geographically isolated a little bit from the main job centers. You're looking at a 20 to 30 minute commute easily to get really anywhere in the valley, right?
Yeah, and while there are some local employers up there, it's not enough to support the amount of multifamily supply that's been built. The market attracted a lot of development because land was cheaper and permitting was easier than downtown or Central Reno. But cheaper land doesn't matter if you can't fill the units, and that's what's happening. Properties are stuck at 70 to 80% occupancy, which means they're losing money every month. Let's talk about the rents. Despite the occupancy problems, effective rents actually grew 4.7% year over year, and that was at $1,739. That's not terrible rent growth on the surface, but I guarantee you that rent growth is being achieved through aggressive concessions. Properties are listing at $1,950 asking rent, offering 2 to 3 months free, and landing at $1,739 effective rent for concessions. And here's the nightmare scenario for North Valleys. There's over 1,800 units that are still in the pipeline. So that's 36% of the entire metro's remaining supply, all concentrated in a submarket that's already struggling at 76% occupancy.
Yeah, I'm not sure how that market absorbs another 1,800 units without occupancy dropping, probably into the 60s. Unless something fundamentally changes, a major employer relocates to maybe the North Valleys, or there's some infrastructure improvements which have been ongoing, or there's some sort of dramatic population shift, that math is really hard to get to. Location matters, and it's always mattered in real estate, right? You can have this beautiful brand new Class A property with all of the amenities, but if you're not in that prime location that makes sense, it's easy to get to, you're going to struggle a little bit. So North Valleys, unfortunately, I think that's kind of where they are. There's probably going to be some buying opportunities in 26 with that over-leveraged owner facing refinancing pressure and needing to sell.
Yeah, but even opportunistic plays require real expertise. You're going to need aggressive marketing, realistic concession strategies, and excellent property management. Probably deep pockets, too, to weather the storm until the market stabilizes. This is not a market for passive investors or inexperienced operators. The easy money has left North Valleys, and what's left is a tough operational grind.
Okay, so let's go ahead and look at West Reno, which I think is a much more positive story.
Yeah, and West Reno is interesting because it delivered strong performance in 2025 while still facing meaningful supply challenges. Occupancy climbed from 82.9% at the end of 2024 to 90.8% at the end of 2025. That's a 7.9 percentage point gain. That's the second best occupancy improvement after downtown. And West Reno did it without the wild quarterly swings that we saw in downtown. This was steady, consistent absorption. Effective rents reached $1,800, and that was up 6.7% year over year. That's the highest absolute rent of any major submarket except Central Reno, and the rent growth was strong. West Reno attracts a different demographic than downtown or even Central Reno. You're getting families, professionals who want suburban living, access to good schools, or proximity to both downtown Reno and Lake Tahoe. And that demographic is less price sensitive than the younger urban renters in downtown. They're willing to pay for space, parking, and a quieter environment. That gives operators a little more pricing power.
The supply pipeline requires attention, but I think that this market can actually handle it. And again, that difference between a great site and an okay site in West Reno is, could be 10 to 15 percentage points of occupancy. So something to think about. But let's go ahead and talk about Sparks, because that market actually surprised us in 2025.
Sparks is the transformation story of the Reno market. This is no longer the budget option or the afterthought. It's a legitimate, high-quality submarket that's commanding premium rents. Occupancy ended at 91.3% at the end of 2025, up 7.7 percentage points year over year. That's strong and healthy recovery. But here's what really stands out, the rent growth. Effective rents hit $1,761, up 9.7% year over year. That's the highest rent growth of any submarket in the entire market. Higher than downtown, higher than central, higher than everywhere. And these aren't artificially inflated rents achieved through later pullback of concessions. This is real rent growth driven by demand and market positioning.
And I think there's a couple of things that are driving that success in Sparks, right? We have economic development. There's Tesla. They've expanded retail along Vista Boulevard, better highway access, newer restaurants, amenities. They've invested a lot in infrastructure, and I think it's paying off. Renters who used to see Sparks as that lower cost alternative to Reno now see Sparks as the desirable place to live, and they are willing to pay for it. The market proved it can absorb supply in 2025, and we think it's going to continue to do so in 26.
And for investors, Sparks is compelling. You're getting strong rent growth, proven absorption, manageable pipeline, and positive economic development trajectory. All right, so we covered the major submarkets. Let's talk about what's coming in 2026 and what market participants need to be thinking about.
As we're looking ahead to 26, there are several critical factors that are going to shape market performance. Let's start with supply, because this is actually good news. Only 1,060 units are scheduled to start leasing in 2026 compared to the roughly 2,300 units in 2025. It's a 54% reduction in new supply hitting the market. And if absorption continues at the 2025 levels, about 2,900 units absorbed, the market's going to absorb all new supply plus another 1,800 units of existing vacancy. So that could push market-wide occupancy above 93% by year end of 26. That would finally give operators some real pricing power. When you're at 93 to 94% occupancy, you don't need to offer all those concessions, and you can be selective about those residents, push rents a little bit more aggressively, and your cost per lease should drop dramatically. But there's a big assumption in there. We're talking, again, stable economic conditions, continued job growth, no recession. If the economy stumbles, that absorption could slow down significantly.
Right. But assuming things stay relatively stable, the supply-demand balance is shifting in favor of operators for the first time in a while. Now let's talk about something that's going to affect operating budgets in 2026, and that's the ILS cost increases. This is something a lot of operators aren't prepared for, but throughout 2025, many communities benefited from promotional pricing on ILS platforms. Zillow acquired Rent.com, and during that transition period, they were offering 90-day free promotions and heavily discounted rates to keep properties on the platform. Those promotions are ending. In 2026, properties are going to face full pricing for ILS advertising, and it gets expensive. Zillow Premium, the last time I checked, was $725 per month. Apartments.com Platinum was $1,200 per month. Combined with just those two ILSs, it's about $2,000 per month. And that's before you add things like social media advertising or search engine advertising, SEO, graphic design. You're looking at potentially an additional $3,500 to $4,500 per month in total marketing spend.
So for a 40-unit property with 20% annual turnover, that's 8 leases per year, right? You're spending $4,500 to $5,500 cost per lease just on marketing. And 2 months free concessions at $4,400, you're close to $10,000 total cost per lease. That's 4 months of rent to fill a single vacancy. It's just really not sustainable. And property level NOI cannot support that kind of cost structure long term. So this is why we're just so passionate about professional marketing as an alternative to concessions. If you invest your $2,000 per month in professional conversion optimized marketing, you can fill those units without offering the 2 months free. Your cost per lease drops from $9,000 to closer to $2,500. And that matters tremendously for your cash flow. A 50-unit property with 20% turnover, your 10 leases per year, that difference between $9,000 cost per lease and $2,500 cost per lease is $65,000 annually. That goes straight to your NOI.
And I hope you guys are listening to that because those numbers are just crazy. But this is really what it takes to market an apartment community. We all know that we want to be on the ILSs because that's where all the renters are searching. But then we also know that in a competitive market, it really does take some more advanced strategies through social media, search engines, and things like that. And once you add all that together, it really starts to pile up. So operators in 2026 need to make a choice. Continue down the concession path and accept massive cost per lease, or invest in professional marketing and sales execution that delivers better results without all the giveaways. So let's talk about retention for a minute, because this is the other big challenge operators are facing. When a resident is paying $2,200 a month, for example, with 2 months free, their effective annual rent is actually $1,833 per month. That's a 17% discount. And at renewal time, that resident sees competitors offering the same deal. So they can move across town, get the same 2 months free, and essentially save 17% of their annual housing costs. This creates a vicious cycle. Properties offer concessions to fill units, which trains residents to expect discounts, which drives turnover as residents move to capture concession value, which creates more vacancy that requires more concessions to fill.
Breaking that cycle requires really, really great property management, fast maintenance response, professional communication, community events. Make residents love where they live so much that they're not willing to move just to save that 17%. We saw this play out with one of our communities. We had some major maintenance issues, but even then, we maintained 95% occupancy because we communicated honestly, we fixed the problem, and we treated residents with respect. They stayed even though there were plenty of newer, nicer options offering concessions. And honestly, that's the lesson. Property management quality matters more than most people realize. The buildings matter, location matters, but execution matters the most.
And to kind of wrap things up, the Reno market proved that it can absorb supply. 2,931 units absorbed with occupancy rising to 91.4%. That's a healthy market, but it came at a cost through widespread concessions and rising marketing expenses. The critical insight is that market data significantly understates the concession burden that we're seeing. Nearly every property is offering 1 or 2 months free, yet reports show only 23% offering with the 6.2% average concession package. That disconnect means effective rents are overstated, and anyone using that data needs to adjust their assumptions.
Looking ahead to 2026 and what this year brings, supply pressure is easing dramatically, only 1,060 units starting lease up versus 2,300 in 2025. That should allow the market to stabilize further and potentially let operators reduce concessions in the second half of this year. But marketing costs are rising as ILS promotional pricing expires, And the operators who win in 26 will be those who understand that professional marketing beats discounting. Properties that invest in conversion optimization and maintain high service standards will outperform those stuck in that concession cycle.
Yeah, and whether you're an investor, developer, or an operator, the key is being realistic about market conditions and executing with excellence. The Reno market has proven demand is there. Now it's about capturing that demand efficiently and profitably. We'll continue tracking these trends throughout 2026. And if you found this analysis valuable, make sure you subscribe to our podcast, follow us on social media, and subscribe to our newsletter for ongoing market updates.
And if you want to discuss how these trends impact your specific portfolio or investment strategy, reach out to us. Our team at Next Level specializes in professional property management and marketing that drives superior performance. Thanks for joining us, guys. That was our deep dive into 2025. Here's to a successful 2026.